welcome to Deal Nation. On the show today, we're joined by Stephen Hall. He's the CEO of Robert Hall and Associates. They are tax experts with a ton of experience in the real estate investing industry. So having Stephen on is a real find for us. How are you, Stephen?
Great. Thank you, Michael. Thank you for having me on the show.
Oh, I'm really excited to really dive into this topic, and I'm being serious. I know that taxes aren't necessarily on the surface the most exciting thing, but the audience here at Deal Nation, everyone is an entrepreneur. And as an entrepreneur, understanding your taxes, hugely important. So we're gonna really dive into that from an entrepreneurial perspective. But I'd love to know, kind of before we really get into the nuts and bolts of this, how did your company end up really finding that well, I know you have multiple specializations, but a specialization in real estate and specifically into wholesaling and family mastermind, that niche level of real estate?
Well, how we got into it is our family we have been landlords for the last 20, 30 years. So naturally, we understand what it takes to be a landlord. And we also understand what it takes to deal with regulatory environments. For example, we started out in Los Angeles where the local cities will want rent control. So, and now they're talking about having a czar to decide how much you could raise your rent in some of these zip codes because they can. So we've learned just because you file a tax period doesn't mean that's all there is to it with you as a landlord to collect money. You got to deal with permitting. You got to deal with regulatory agencies and their rent control statutes, Section 8 statutes, all kinds of variables that come up. So naturally, we really understand what the landlords need and what their wants are. And also, frankly, how to navigate through these troubling times sometimes when you have local government trying to dictate how to run your business.
No, I love that. And one of the things we talk about often on Deal Nation is the importance of outsourcing the things where subject matter expertise is necessary, right? Because as an investor, you want your focus really to be on finding and closing deals. And often just in having those conversations with sellers, whether they own a distressed property, or they own a piece of land, that's your sweet spot, is finding profitability in those conversations. And if you have to then go out and become a deep dive marketing expert, a deep dive taxation expert, a deep dive chief financial officer, where are the hours going to come from? There are times in your business where outsourcing to the experts is the only way forward. And I can't think of a better example than covering yourself in terms of taxation and, like you said, local regulations and having that expertise.
You hit the nail on the head. I mean, for example, if you're looking into a new area to buy, you still have to take the time to go to the police station, find out what the crime reports are, or find out, what the local town will require in permitting, et cetera. Well, it's no different when you're doing due diligence for a rental property to do due diligence and planning for your tax strategy. Because it's not what you make at the end of the year, it's what you keep. And that's something that people forget. You can work your tail off all year long, make all this money, but if you're not planning, the government's going to say, thank you very much, I want some of that money. But if you plan accordingly, the government will say, here are the rules and regulations, and you don't owe us anything because you planned appropriately and way in advance to pay a big fat zero to the government.
Yeah, it's addition by subtraction, right? Like, so many entrepreneurs are always looking for, well, how do I make more money? Like, where's my next deal going to come from? Am I ready to start a side hustle? And it's always addition by addition. Whereas if you really understand your taxes and you're working with a company like yours, if you can reduce your tax burden by $50,000 at year over year, that's $50,000 extra, right? It's addition by subtraction. And so that is a huge win for companies if you can get that right year in and year out.
Correct. It's all about planning ahead, because at the end of the day, if you want to save $1 million, you want to save 500,000, it doesn't matter. It's all about planning, because we could get you to zero. It just comes down to what industry you're in, what zip code you're in, and figure out your cash flow to figure out what makes sense specifically in your very personal scenario in life. For example, you may be a single or bachelor, just getting into the business where you don't have to worry about kids or a spouse. You may be a a person that's 50 years old with 2 kids in college, divorced, taking care of mom and dad. That's a different scenario. Or you may be a married couple with 3 kids under 15, and you're trying to factor in how to take care of putting 3 kids through college in a couple of years. So every person's going to have a different strategy of how to get to that zero tax number, depending on where they are in life.
Yeah, that's a really important point that you're making, that you have to take not only the business considerations into mind, but also the personal considerations, the profile of who that person is. Because in real estate, in this niche of real estate investing, most people are incorporated as an LLC, which means that and a lot, unless I'm mistaken, most of that's going to be passed through to their personal tax filing. And so you would absolutely have to take into consideration both personal considerations and business considerations in order to fine tune that for that client.
Correct. And let's talk about LLCs real quick. So
Yeah.
LLC stands for limited liability company, but I'm going to have a rubber band here. An LLC is very flexible. So you could be a partnership, you could be an S corp, you could do it under you personally, or you could be something called a C corp. So it's not rigid. It's not like the stapler that's rigid where I can't move it around. It's black and white. Because when you
Yeah.
incorporate a company as a corporation, it's a stapler. It's black and white. It's only 2 ways you can tax it. You either tax it as an S corp, where all those profits go to your social security number, or you tax it as a C corp, where all that profit stays at the company level. And if you take money out, you get taxed twice, where the corporation will charge you a tax at the corporate level, and then they'll tax you at the personal level. And on top of that, you can pay yourself a salary. But sometimes that company that's a C corp is great for benefits. So, for example, if you're taking care of mom and dad and they have to go into a nursing home and you're spending 150 grand a year to support their nursing home bills, that C corp may be a great vehicle to where we can wipe out your tax bill. But if you don't need that C corp and you're going to be an S corp, you may want to, instead of having a rigid structure like under the corporation regulations, you want to be flexible like a rubber band, where you could be an LLC one day, taxed as a partnership, then the next day or a year or two later, you might want to elect to be an S corp, and you could do that. So you have all the flexibility in the world. But with that flexibility, what that means, like you said earlier, Michael, all those profits will go downstream like a waterfall to their social security number. So whatever activity they have under that federal ID number at the LLC level, they're going to have to plan ahead. Otherwise, it's going to hit them downstream, down the river, as I call it, to their social security number.
Yeah, and what you're describing is something that a lot of people are focused on, which is how do I make this business scalable, right? Like I might want to go in looking to close 2 deals a month, but I want to scale up to seven figures. So if I go in as a base level LLC, or yeah, just a base level LLC, I'm not ready to be an S corp yet. I'm not ready to be a C corp yet. I don't have the asset structure to require it. But what you're saying with that flexibility is you're not locked into what you choose initially. Your corporate structure fits the needs of your business as it scales up. It's just a question of making sure that by working with a company like yours, they know when to make the pivot to the larger structure, or to the structure that's a bit more tailored to their business for that time.
You're absolutely right. And every phase in life, you may have a different structure or a different presidential administration or tax system will influence your decision in terms of what to do. So that's why a popular vehicle for wholesalers, for example, may be an LLC taxed as a S corp if you have a large profit. But if you're just getting started with losses, you may want to be an LLC taxed as a partnership, because your chance of an audit on an LLC taxed as a partnership is only it's 1 out of 400.
Okay.
Whereas with an S corp, you can take the loss, but then the IRS will want to verify you what's something called shareholder basis to deduct that loss, which could limit your deduction. So S corps are great if you're profitable, but if you're not profitable and you're just ramping up, an LLC taxed partnership is the way to go, because you don't want it under your name. Because Michael, guess what percentage what the odds are to get audited if you have this activity in your social security number in your name?
What?
10 times more likely.
10 times.
10 times
Wow.
close. 10 times it's 1 out of 45 if it's under your name, and 1 out of 400 if it's in an entity like a partnership. So
Wow.
let's get
That's
straight
crazy.
here. Do you ever want anything in our name anymore, Michael, from a tax write-off?
No, no.
No,
Yeah.
we want to decrease our chance of an audit by a factor of 10. And the
Yeah.
way you do that is you set it up under a partnership. And then if you're profitable, we do an S corp.
And one out of 400 still sounds high to me. 1 out of 45 is wild. That's a busy IRS.
It's a very busy IRS regulators, right? Because
Yeah.
when you're a sole proprietor, the IRS over the years have realized when you do everything under your name, number one, you're typically starting out, or number two, they think you're not going to have an advisor representing you when they audit you. So they want to go after people that are not being represented by somebody, because that way they can close those cases faster and hand out those tax bills even faster.
I see. Okay. One of one of the reasons I really wanted to have you on the show is that I kind of a common trope really with wholesaler investors is, yeah, but nobody really understands my business, because wholesaling is a very niche industry within the real estate space, right? It's not like the MLS size of real estate. It is a targeted niche part of the business. So if you're wholesaling houses, distressed properties, or you're flipping land, that's a very specific business model. And finding someone that is an accountant that understands that business model, that is a tax pro that understands that business model, is actually kind of difficult to do, right? So you understand that niche. You're well versed with a lot of these companies, so it gives you it gives you a chance to really kind of help people who by truly understanding their business. So I wanted to go through, and just because our listening audience, we've got people that are running 7 and 8 figure real estate businesses. We've got on the opposite end people that just formed their LLC yesterday,
Yeah,
and they're looking for that beginner advice. So really, it's the whole gambit that of this business model that people are in. So I kind of wanted to just start at the beginning and ask you some as I'm starting up my entrepreneurial endeavors, some base level questions, because I think that'll help people. Sound good?
absolutely.
So, business formation, when somebody goes into this, we were just talking about this a little bit, but your average profile or somebody that's going into wholesaling, they're either doing this as a solo entrepreneur, or they might have one business partner, but it's going to be pretty small. Typically, it's going to be a solo entrepreneur. So, do you have any kind of tax advice, even before they filed articles of incorporation, that they want to think through as a solo entrepreneur going into this business?
Yeah, absolutely. So as a solo entrepreneur, you're going to need some capital to get started. Right, in most cases, right? You gotta get the word out there. You got to spend some money on advertising, get some attention units going. So if you're spending money, you want to look at where you're pulling the money out of. The biggest mistake I see from many entrepreneurs, they just pull money out of their retirement account, their 401k, or
Mm.
their IRA. And there are loopholes to where you could roll your retirement account over to something called a ROBS plan, and set up a rigid C corp to put money in there, and deploy that money into the business without paying any taxes on the money.
Oh, wow. Okay.
And I can't
So,
tell
but
you, for example, go ahead, Michael. You were going to say something.
oh no, go. Please continue.
Oh, okay. I'll give you an example. Unfortunately, I saw this new client a couple years ago. He just opened up a grocery store. He was a first generation American, worked at the post office for 25 years, rolled his money into a retirement account. He was excited. He's like, I can't wait. He opened up the grocery store, comes into my office, said, I pulled all my money out of my 401k to open up this grocery store. My heart just sank. I wish he called me, because I would have had it roll over all that money into through a ROPS plan into a corporation. So that way he would have paid zero tax on all that 401k money to open up that grocery store. And you could do the same thing if you're just starting out and you're going to pull money out of retirement. Let's think twice about doing that, and let's be strategic on how you do that, so that way you don't pay the government that money.
Yeah, that's fantastic advice. I would venture to guess that a lot of, or a good percentage of the audience would have thought, I can't touch those accounts. I'm going to get penalized way too hard. So I'm going to need just standard savings, right? I'm going to need actual liquid assets to be able to fund this. But you know what you're saying, if you could take some of that, roll it over, not get the extra early withdrawal fees or any of that, that could be a huge hack for people that might be sitting on some savings that they thought was untouchable.
Correct, because with AI, let's face it, artificial intelligence is not going to be leaving anytime soon. It's going to get bigger and bigger. So you have a massive corporate workforce that's going to get the pink slip, and they're going to have to find something else to do. And you may see a lot of new wholesalers come into the industry because they love real estate and they don't want to go back to corporate America. Well, they're going to have those 401ks that they could tap into to start that business.
Yeah, no, that's great advice. And then, you know, I know that it sort of a fear factor for people in year one is, you know, let's say that the solo entrepreneur closes in the first 3 months, they close a deal, that deal nets them 25K. And then, you know, pretty much every month after that, they're averaging at least one deal. So they end up making $400,000 in their first year, which is more than they've ever made, right? But their money's not coming out of their paycheck, right? They don't have a W-2 that's keeping them in a safe zone. So they start to get nervous. Like, how do I account for this? Should I be taking out, you know, 18%? Should I be taking out 28%? I don't know, right? So they get kind of stuck in this um, limbo space of not really being sure how much or how little to allocate. So, kind of with that sort of idea in mind, are there any year one advice that you would give so that going into Jan, Feb, and looking to file your taxes for the previous year, you're not in panic mode. You're in just, you know, smooth sailing mode instead.
Absolutely, Michael. It's the first thing is it's like I said at the beginning, it's not what we make, it's what we keep. The first thing we want to do is plan in the month of August, September, and find out when your forecasted profits are going to look like and put together some strategies that you can execute, because we need these strategies executed before December 31st. So that way they can lower your taxable income for 2025. So that way, when it comes to tax time in April to pay the government, you're paying them a big whopping zero if possible.
Yeah. And then you generally have until April 15th to make money move decisions, right? So if you wanted to, for instance, you wanted to take some of your profits and stick it into like a SEP IRA, you have until the 15th to do that, right? So that
It depends. So what you're
okay.
describing is if it's a regular IRA or SEP IRA, you have till April 15th to make those decisions. However, if you want to do fund a retirement account with steroids with more flexibility, you have to set up those plans before December 31st.
Okay.
Now, you could put $1,000 in the account to set it up before December 31st. You could fund the plan later, but it's important you get that account number set up before the 31st of December. So that way you have flexibility on the timing of when to make those fundings.
Okay. Yeah, that makes sense. You know, I know that speaking of like wholesaling as a niche industry, right? Has there been anything that you guys have come across as a new strategy, and meaning like you start working with wholesalers, you start really diving into that business profile, and you guys start getting creative and go, oh, you know what would work great for this industry is. Are there any kind of examples like that where you guys have come up with some fun ways for people to really reduce their tax burden?
Absolutely, Michael. One of the most popular strategies right now, and since these wholesalers are finding so many incredible deals, you're going to notice that the fair market value of the property is close to the fair market value of what it was in 2021 or 2022. And if you look at the lien that's on the property, the loan balance may be close to what the home is worth. Well, guess what you could do? You could buy that property subject to under another LLC with very little money out of your pocket. And then guess what the government allows you to do with that property, Michael?
Write off part of it?
spot on. You get to write it off. So if it's an Airbnb rental, right?
Yeah.
You can take what's called a cost segregation study and wipe it out. So let's say the property's $250,000, and we want to cost seg it. There's a potential, no guarantees in life, but let's say the $40,000 deduction on the first year, just on the depreciation. And how much money did you put into the property? Very little, because you just took over the loan of the deal and you started renting it out on Airbnb. That's an example of how, if you look at the liens that are on the property, you may be able to just take over some of these properties at Airbnb. Now, let's say you need a long-term tenant or rent to own it. You could do that as well and get the same write-off. Now, here's the difference. We just have to make sure that your field of real estate is your full-time job, because you have to be a real estate professional. And the government rules for being a real estate professional is you have to spend over 50% of your workable time on a 40-hour work week in real estate, and over 750 hours a year in the field of real estate. Mm-hmm. So let's say you're a nurse, and then on your non-working days, you're wholesaling. It'll be difficult to justify you as a real estate professional, because you may be spending over 50% of your workable time as a nurse. However, if you do an Airbnb short-term rental, the government doesn't care about the real estate professional rules. They just care that it's a short-term rental. So if you're a nurse and you want to get those losses, you got to do the short-term rental. But if you're full-time in real estate, you don't have to do the short-term rental. You could do the traditional rent-to-own structure, or to rent it out over a period of time to claim that depreciation deduction.
And you said you would open that, like most people, any rental business that they would own, like if you had let's say you had 6 Airbnbs as short-term rentals, most likely you'd house all 6 under separate LLCs to have the LLC protections for each property. But you're saying that the savings that you're going to realize via write-ups of depreciation and et cetera for each one of those properties are just going to offset what you as an individual at the end of the year are going to have to pay, maybe even offset it down to zero.
Correct. So for example, let's say you made $200,000 on your wholesaling business in profit, and you bought 5 of these properties subject to throughout the year.
Yeah.
Now, and each one is giving you a $48,000 write-off. The government's going to give you a $243,000 deduction against your $200,000 profit on your wholesaling business. Now, how much profit do you have on paper with the government?
Minus 43. Yeah.
Correct. And how much tax are we going to pay? Zero. You're going to pay 0 tax to the federal government. Now, in certain states, the states may say, you know what, that's great, but we don't recognize that depreciation deduction. And they may still require you to pay a tax. But who cares? You're still going to wipe out that federal tax.
Yeah. No, that's phenomenal. And like you said, like in that case, we're talking about, a huge chunk of money being added to your business. We started off basically talking about addition by subtraction, right? Just subtracting that depreciation ends up with an addition of, could be $100,000, 6-figure addition to your business just by having that in your back pocket.
That's right, Michael. Now let's ask this question. Since we just said that, is it worth starting the search in the month of August to find those properties to pay 0 tax at the end of the year?
Yeah, obviously. Definitely.
Of course. But when I get those calls from the clients in mid-December saying, Steve, I forgot about taxes. It's December 15th. How do I wipe out my tax bill? It's going to be kind of hard during the last 2 weeks of the year to find a couple of subject to properties to buy to wipe out that tax bill.
Well, and it's not like you're going from, it's not like you're saying, well, you're a wholesaler, but if you really want to offset your taxes, you're going to have to go out and buy a car wash, which is a totally separate business. It's a totally separate business model. You're basically saying in your pipeline, in your existing pipeline, find a property that rather than wholesaling it, you're going to subject to it, and then transition it to this depreciation model part of your portfolio. Like if you're doing that, you're just looking for gems hidden in the pipeline that you already have. It's not learning a new skill set, really. The subject to stuff, like there are easily, readily available resources to learn that, but you're activating your own pipeline to create these tax benefit strategies?
All day long. For example, if you're in Orlando and you're wholesaling in Orlando, there are tons of Airbnb properties for retired landlords that want to be sold, and the loan balances are close to what they paid for it in 2021, 2022, or they did a refinance. So you get
Yeah,
subject to F3, 4% when the interest rates are 7 or 8. So now you get the low interest rate, plus you get the tax benefit from day one. So why
yeah,
wouldn't I sign up for that? It's a no-brainer.
absolutely. So, one of the questions I was going to ask you, and I'll ask it anyway, even though it's now pretty rhetorical. On a scale of 1 to 10, as a wholesale investor, solo entrepreneur, how important is it to bridge into having a portfolio? So for tax benefit reasons.
10 out of 10, and especially right now when you look at the interest rates for 40. I forget the number, Michael. Maybe you know better than I do. Is it around 40% of all houses are under 4% interest rate?
I don't actually know that. I don't know. I would trust you on that, but I don't know.
Okay, so let's assume 40% of the homes in America are under 4%. It's a golden opportunity if you could take over those loans for the next 30 years to pay, because who knows when we're going to see those kind of low interest rates again.
Yeah. Yeah, I was
No,
just having a conversation with a friend recently. I think you can probably back me up or shut me down on this. But I was speaking to a friend recently. He said that interest rates have always been around 3 or 4%, and I said no, I'm pretty sure that's an anomaly. Like that was a short period of time where they were that low, but historically speaking, they've been quite a bit higher, maybe even like 7, 8%, with spikes in like the 80s or whatever, right? So it sounds like those 2021 kind of properties that you're talking about, like that's limited inventory, and you want to find it because I agree. I don't know that we're going to get back to those kind of interest rates in the foreseeable future.
you're spot on. My first house that I ever bought in 1997 was around 7% interest rate. And in 2007, my interest rate was 6%. And I thought that was a screaming deal
Yeah,
for a 6% rate in 2000 and late 2007, early 2008. And now we're in the 8 percentile, late sevens, early eights. And so we did have a period where they were much lower, obviously during the COVID era. But that's the beauty of being a wholesaler. You get to see all this inventory. And
yeah,
through that, if you look at the title report, you'll know what year they got that loan. You'll know the terms they have. You could make that a sub to candidate and keep it long term for the write offs.
so in terms of we talked about sub two fairly extensively. Do you have what you would consider like a triple A rated portfolio for a wholesaler? Is it a mix of things? What does that look like in terms of having like perfect tax deduction strategy?
From a tax deduction perspective, if you're in an area where you can get that 3-4% rate, and you could do a rent to own portfolio to where the tenant keeps up the property where you don't have to maintain it, and you could hold that paper for a long period of time. It's a beautiful strategy for tax reasons, number one, and number two, you're arbitraging the current rate versus what the rate you have, and you're not putting a lot of capital out of your own pocket. So it's
Yeah,
a great way to grow your net worth while you're getting your short-term cash flow from the wholesale industry. Because since you're in the business anyway, in the day-to-day business, you can just add an extra step to pull the title report to see what year they got that loan to get an idea of the interest rate that the underlying paper is sitting at.
yeah. No, that's great advice. All right, so I do want I love that we've been able to focus in on wholesaling as a business and tax strategies around that. But I do want to take a little bit of time, just a couple minutes here, to kind of focus on the upper echelons of our listening audience. The upper echelons of our listening audience, when they've already got probably a 7-figure investing business, they often look to expand into new profit streams. Like coaching is a big one, to start taking on coaching clients. They might get into software development if they've got a tool that they were using in their own business that they now want to be able to offer on a subscription basis to others. That's actually how launch control got started. So when people are going from having, in a let's say a tax ideal situation for the wholesaling business, and then they're looking to take on new profit streams, what advice would you give them to make sure that they don't accidentally stumble into, a higher tax burden at the end of the year?
Well, a couple of different flavors to that. So the first is software. You hit a topic that's important for all the listeners. If you're going to set up your own software, it's important to understand that software. It's very common for buyers of software companies to buy a C corp, like we talked about earlier with this example. And the reason why is that the government, if you hold a software company for 5 years, after the 60th month, you could sell the software company for the first 10 million in profit is tax free from capital gains.
Really?
Correct. It's
Wow.
called Section 1202, Section 1202. Now,
Okay.
to make that possible, some people say, "Oh, I started programming the software, but I haven't set up the corporation." I want to pull my hair out when I hear that, because this moment you have an idea, you want to push that button to start that corporation, because now you started the 5-year clock
Yeah.
for that $10 million exclusion for that capital gain when you sell that software company.
That's a pretty lofty exclusion.
And now it gets even better. If you're married with the right estate planning attorney, you could have a trust for yourself, a trust for your spouse, a trust for each one of your kids. So let's say you have a family of 4. You could have 4 trusts own that software company. Now, when you sell that software company, you could have a $40 million exclusion, because you'll be able to get a $10 million exclusion per company.
Yeah, that's like $10 million exclusion. I mean, we're getting into the big money topics, right? Like everybody would like to be in a field where they have the ability to have a $10 million write-off. But like I said, we were talking upper echelon, and that's where people are seated. Like that's the kind of thing that they're looking at. So it's important advice.
Correct. And that's why when we look at families that are making good money and they want to start a software company, the first question I ask, are we building this to sell it, or are we building it to lifestyle it, where you never plan on selling it? Because you're going to lifestyle it and we're going to have losses. You don't plan on selling it. We may have an LLC tax as a partnership for the business, so that way you can strip the losses downstream against your other source of income. But if you plan on building it to sell, we want to preserve that $10 million exemption per stockholder exemption on the cap table for the software companies. So that's one example. The other tactics that are popular, like we just talked about, subject to, is to buy additional real estate, especially through the industry. The biggest mistake I see entrepreneurs make is when they try to go into another industry. Like you said something earlier, buying car washes. You could go out there and you could buy car washes, and you could buy utility trucks to lease them to the utility companies and all that for the write-offs. But the question is that your core focus? Is that where you want to put your time? Because you still have to put in at least 100 hours a year, because the government requires you to put 100 hours a year into a project to be considered actively involved in the business to take the deduction. So that's something you have to factor.
How many hours a year?
100.
Oh, okay. Yeah.
Outside of real estate. So, for example, let's say you have cars on Turo, or you're investing in an equipment leasing business, and you buy $1 million worth of equipment, and let's say hypothetically, government gives us 100% bonus depreciation again, and you have $1 million deduction for buying all that equipment on year one, and you want to show $1 million loss on your taxes. Government want to make sure you spend at least 100 hours a year in that business. It's a great write-off, because at a 37% tax bracket, you're going to save $370,000 on that $1 million purchase. But you still have to look to see, are you better off buying a couple more buildings with that money, because that's your business well, or do you want to go into another business industry to grow your net worth? So you got to factor in your time to make sure you have the appropriate amount of time to invest in a new industry.
Okay. Yeah, no, I think that's good advice. Anybody looking to make that decision, they're always going to be weighing the potential profitability with the potential time loss for them, right? Because usually by the time they have a seven-figure wholesaling business, they've got it dialed in and they are not spending anywhere near 40 hours a week. They're probably not spending 15 hours a week. They've got a team doing everything for them. So the last thing that they want to do is take on a 30, 40 hour a week headache, So it's good. It's a good idea, like you said, to really kind of weigh things out, see what makes sense for you in your future.
Absolutely. I agree.
Yeah. All right. Well, Stephen, I can't thank you enough. This has been really, really useful advice for the audience. For everyone listening, we're going to have all of Stephen's contact information in the episode description below. But I really encourage you for this episode in particular to ask questions. Right? I asked a few of the questions that I thought that you, the listening audience, would want to hear. But I'm sure you have more, and you have more specific to your business. So drop some comments below. We'll loop Stephen in where we can, and then of course, obviously, reach out, follow the links in the episode description below, and reach out and get in touch with Stephen. Stephen, anything that you want, any last little tidbits you wanted to add, or any get in contact with you, suggestions that you want to give for people?
Yeah. So if you guys have questions or you're not sure how your taxes are being filed, you can go to our website, roberthalltax.com, that you see right here. And just ask under the contact us in the notes, just put down you would like a free 30-minute consultation. And our office will review your filings and see if we can get you some money back and amend those tax returns. Or we could also amend those tax returns to accelerate the depreciation if you haven't taken the depreciation yet. So we can look at all those tax strategies to help you today and potentially unwind some of the tax you've already paid in the past as well.
Okay, perfect. All right. Well, thanks again for taking the time, Stephen. I really appreciate it. And yeah, everyone listening, let us know if you got questions.
Thank you, Michael.
Absolutely.